This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the Premier Trade Forex Report with Scott Norse.
Good afternoon, traders. I'm Scott Norse here with your Forex Report. Wrapping up the week, it's Friday, August 17th, 2007. Wow, what a week. Just when we thought things couldn't get any crazier, in the final 24 hours of trading, the Fed surprises the market with a cut in interest rates today. No, it wasn't in the overnight lending rate known as the Fed funds, which remains at 5.25%. The Fed actually cut the discount rate by 50 basis points to make money for banks from the Federal Reserve a little cheaper and ensure liquidity in this credit crunch. The Fed has actually been injecting liquidity on a broad scale all week, and today cut the discount rate so that banks that are still in need of cash can simply come to them. Critics of Ben Bernanke are today calling him a rock star and maestro on trading floors. Many economists say this was the perfect move from the Fed, who will leave its target lending rate at 5.25%, at least for now. Of course, several big Wall Street firms also believe the FOMC will now cut the Fed funds rate by 50 or 75 basis points this year. The majors and the crosses went absolutely nuts when the news hit wires. Trading had already been active overnight with big ups and downs across the board. Today's surprise from the Fed affected carry trades the most right off the bat as stock futures soared and the yen plunged lower. Many major currencies also rebounded against the dollar, both on the back of rallying carry trades and speculation that the Fed would cut its target lending rate later this year. Once the stock market opened and began to bounce higher and lower, carry trades tracked the Dow closely, and we witnessed big price action in all pairs in both directions. It certainly has been an exciting and profitable day for many, but we personally are ready for the markets to settle down a bit from here. Now to the big picture. Volatility kicked into high gear as carry traders continued to rush to the exits this week. The global credit crunch worsened so much that central banks, including the ECB and the Fed, were forced to inject hundreds of billions of dollars in excess liquidity into banking systems just to prevent a catastrophe. Not since September 12, 2001, the day after terrorists destroyed the World Trade Center, have we seen central banks add so much cash. Additionally, the Fed today cut the discount rate for banks by 50 basis points. This certainly changes things a bit, but in the longer term, we still have some waiting to do before we can effectively forecast exchange rates very far out. Bets that the Fed will cut rates should hurt the dollar substantially in this era, but we could also see such a move give the U.S. economy a much-needed shot in the arm. On the other hand, today's move by the Fed does not fully put us out of the woods in the credit debacle, and carry trades could still find trouble in the weeks or months ahead. As we have seen, losses in carry trades often promote dollar strength. The big picture is still very unclear, but we have been able to rely on a nice correlation between the Dow and carry trades. Traders now must pay more attention than ever to the interdependence of financial markets and be ready for sudden changes in direction at the drop of a hat. Until next week, have a wonderful weekend. Take care.